Imagine finding out that a single cargo ship getting delayed in the Middle East is like the exact reason your local bank just denied your mortgage application in Toronto or Vancouver or Halifax.
Yeah, I mean, it sounds completely absurd when you put it like that.
It really does, because there's this persistent illusion that major global events happen over there,
Right.
right? And your day-to-day life just happens over here.
Right, completely separate.
Exactly. You see a headline about global trade fracturing or some political shift in Washington, and it just feels like background noise. But then, you go to the grocery store or you get your mortgage renewal letter in the mail, and suddenly the globe feels incredibly small.
It shrinks very fast when it hits your bank account.
Oh, for sure. Okay, let's unpack this. We are looking at a really massive stack of financial documents today. We've got the Government of Canada's Spring Economic Update 2026, alongside some really heavy-hitting mortgage market analyses from True North Mortgage and Pegasus.
And just to be clear, we're not endorsing the politics of these sources. We are strictly looking at the data they're presenting to understand the mechanics.
Right, exactly. We're just the messengers here. Our mission for this deep dive is to decode those hidden structural strings that connect global chaos directly to you, the listener, and your wallet.
Yeah, it's entirely about pulling back the curtain on how those mechanics actually work. And, the overarching theme we're going to explore today is really where resilience meets reality.
Resilience meets reality. I like that.
Because if you look purely at the macroeconomic data, Canada is showing this surprising, almost structural strength. It is navigating these global headwinds remarkably well. But yeah, if you look at the reality of individual households, you're likely feeling a very real, very sustained financial pinch. And understanding exactly why that disconnect exists, like how those invisible strings actually function, that gives you a massive advantage when you're making financial decisions right now.
I want to start exactly there, actually, with that disconnect. Because I was reading through the 2026 Spring Economic Update, and honestly, I was just confused.
How so?
Well, going into 2025, the headlines were terrifying. I mean, there were massive U.S. tariff threats looming, global trade was completely fracturing, and economists were practically screaming about an impending recession.
Oh, absolutely. The sentiment was incredibly dark.
Right. But reading these government updates, we didn't just survive. We actually grew by 1.7% in 2025.
They did. And looking forward, the data shows the International Monetary Fund Projects Canada will have the second fastest growth in the entire G7 for 2026, sitting at 1.5%.
Wow.
Yeah, and then climbing to 1.9% in 2027. So it's a remarkably strong macro position, and it extends well beyond just GDP growth.
Okay, wait, I have to stop you there because I hear these numbers and I'm sure anyone listening is thinking the exact same thing.
And it doesn't make sense.
Exactly. If we are growing and we are outperforming the G7, why does everyone I know feel so economically strained? I mean, it sounds like Canada is wearing some kind of economic Kevlar vest while dodging bullets, but it definitely does not feel like that on the ground. How are we actually growing under these conditions?
Well, what's fascinating here is the sheer speed at which Canadian businesses and infrastructure adapted to those threats.
Oh.
That Kevlar vest, to use your term, is actually a multi-layered defense mechanism.
Okay, so what's the first layer?
The primary layer is the Canada-US-Mexico Agreement, or CUSMA. We often hear about tariffs in the news and just assume, everything is getting taxed.
Right, you hear tariffs and panic.
Exactly. But the specific mechanics of CUSMA meant that about 85% of Canadian goods exports were completely shielded from those recent U.S. measures.
Wait, really? 85%?
Yes, the treaty basically acted as a massive legal buffer.
So because of the specific rules of origin and the trade agreements already locked in, the vast majority of our exports just sail right past the border checkpoints completely untouched.
Exactly. But, you can't rely solely on a legal buffer forever. Which brings us to the second layer of that Kevlar vest, which is diversification.
Right.
When the U.S. market started looking volatile, Canadian businesses aggressively sought out new buyers. And the documents note that since 2024, non-U.S. goods exports have jumped 36%.
36% in just 2 years. That is a massive pivot for an entire national economy. I mean, how do you even move that much product to new markets that quickly?
You can't. Not unless you have the physical infrastructure to actually move it. And this is where timing was just everything.
Oh, like pipelines and stuff.
Exactly. The government's trade diversification strategy was backed by these generational infrastructure projects coming online at exactly the right moment. The Trans Mountain expansion and LNG Canada Phase 1 are prime examples.
Right, right.
Think about oil, for example. Before the Trans Mountain expansion was finished, less than 3% of our crude exports went to non-U.S. markets.
So we were almost entirely captive to U.S. buyers.
Completely captive. But now, that number is roughly 10%. We literally built the heavy physical pipes required to physically access Asian and European markets.
Wow.
And that is how you offset North American trade losses in real time.
Okay, so the foundation is solid. We have CSMA protecting us. We have new pipes carrying our resources across the ocean. And the macro numbers look great. I think the document even noted we added, 3.4 jobs per 1,000 people since the start of 2025?
Correct. And to put that in perspective, the U.S. only added 1.2 jobs per 1,000 people in that same time frame.
That's a huge difference.
Yeah, and our unemployment rate, which peaked at 7.1% in late 2025, fell back down to 6.7% by March 2026.
Okay.
Plus, our net debt to GDP ratio is just 10.2%, which is the lowest in the G7, with the projected deficit actually improving by $11.5 billion.
Okay, but this brings us crashing right back into the reality part of the equation. Because an economy wearing a Kevlar vest is great for the national treasury, sure, but everyday consumers are still getting bruised.
They absolutely are.
And this leads us directly to how a geopolitical conflict happening thousands of miles away dictates the price flashing on the sign at your local gas station.
This is the perfect example of those invisible strings we were talking about. So the conflict in the Middle East severely disrupted traffic through the Strait of Hormuz.
Right.
And to understand the sheer scale of that bottleneck, you have to realize that this single, very narrow waterway handles about 20% of the entire world's oil and liquefied natural gas shipments.
So you essentially choke off a fifth of the global energy supply route overnight.
Precisely. And, when that happens, the global markets completely panic. We saw West Texas Intermediate, or WTI, crude oil start swinging wildly.
Wow, wildly.
It bounced between $80 and $120 a barrel over just a few weeks. It finally settled near $90 by April 2026. But even settled, that is still up 30% from where it was before the conflict started.
And here is where we hit that great paradox of the Canadian economy. I want to make sure I understand the mechanics of this. So as a country, Canada is a net energy exporter. We sell more energy than we buy. So when global oil prices spike by 30%, Canada as a corporate entity actually makes a fortune, right?
Yes, exactly. Economists call this an improvement in our terms of trade.
Okay.
If the price of the main thing you sell goes up faster than the price of the things you buy, your national wealth obviously increases. Corporate profits in the energy sector surge, which means the taxes those corporations pay to the government also surge. It literally shrinks the federal deficit.
Right. It's like a seesaw. So on one side of the seesaw, the national treasury is getting heavier with all these oil profits. But on the other side, everyday Canadians are just suspended in the air, paying out the nose to commute to work.
That is exactly what it is.
Because they aren't collecting corporate oil taxes. They're just paying the price at the pump. Looking at the spring update, national inflation ticked back up to 2.4% in March, purely because of a 30% spike in retail gas prices. I mean, the national average hit $1.81 a liter in April.
Yeah, it creates a very stark immediate divergence. The national balance sheet gets much stronger, while household balance sheet gets much weaker.
Right.
And to try and bridge that gap, the government introduced a temporary suspension of the federal fuel excise tax.
Oh, right. The tax cut.
Yeah, from April 20th to September 7th of 2026, they are cutting up to 10 cents a liter on regular gas and 4 cents on diesel.
But is a 10-cent tax cut actually enough to level the seesaw? I mean, 10 cents helps, sure, but if gas is $1.81, people are still feeling incredibly squeezed.
The tax cut is a Band-Aid. I mean, it provides immediate, tangible relief at the pump, sure. But if we look at the structural mechanics of household finance, what is really helping families keep their heads above water is that wage growth has quietly outpaced inflation for over 3 years now.
Really? It doesn't always feel like it.
It doesn't. But real wages, meaning your wage growth minus inflation, are actually up 1.6% annually since 2023. And if this oil price spike from the Strait of Hormuz is temporary, the Bank of Canada expects inflation to settle right back down to their 2% target by year end.
Okay, but what if those shipping disruptions aren't temporary? What if the conflict just drags out?
Well, this raises an important question, and the Spring Economic Update actually models this out. They call it the global supply disruption scenario.
Sounds ominous.
It is a bit, because if those shipping bottlenecks in the Middle East persist, the pain doesn't just stay isolated at the gas pump. Higher fuel costs mean higher shipping costs for everything, And that inevitably spills over into your grocery bill.
Because you have to put the food on a truck to get it to the store.
Exactly. Grocery inflation is already sitting at 4.4%. Now, remember that Canada imports about 75% of its fresh produce.
Oh, wow.
Yeah, and transporting that produce from, say, Mexico or California relies heavily on diesel fuel. So prolonged energy spikes in the Middle East will absolutely keep Canadian food prices elevated.
Okay, so the government can temporarily cut a gas tax to help with driving costs, but they can't magically wave a wand to fix the absolute biggest expense in anyone's budget, which is housing.
No, they can't.
But surprisingly, going through the data from Pegasus and True North, there is a massive structural shift already underway in the housing market.
We are actually in the middle of a significant rebalancing act. Housing affordability metrics are actively, quantifiably improving. Let's just look at the raw numbers. National home prices have dropped about 20% from their recent peaks.
Right, 20%. That is a massive correction for an asset class that, everyone just assumed would only ever go up.
It is a huge shift. And we are seeing the exact same trend hit the rental market. National asking rents are down nearly 9% from their 2024 peak.
Wow.
To put real dollars on that, we are talking about a drop of roughly $210 a month in Toronto and $320 a month in Vancouver. The national rental vacancy rate has more than doubled, going from a historical low of 1.5% in 2023 all the way up to 3.1% in 2025.
So the obvious question here is, why the sudden shift? How did we go from a seemingly unstoppable housing crisis to a 20% drop in prices?
It really comes down to the simple mechanics of supply and demand finally aligning, and it's driven by deliberate policy.
Okay, break that down for me.
Sure. On the supply side, we've seen a historic surge in purpose-built rentals. Housing starts recently hit 260,000 units, which is way above our historical average of 200,000.
And how did we get builders to actually build that many units? Because they've been dragging their feet for years.
Through very aggressive federal injections. The government pushed $1.7 billion into provinces specifically to unlock supply.
So just handing out cash?
No, this wasn't just throwing money at a problem. It was tied to forcing municipalities to cut red tape and change zoning laws so builders could actually get shovels in the ground.
Ah, I see.
Plus, there was a specific partnership with Ontario designed to reduce taxes and municipal fees by up to $200,000 per home. And, when you lower the cost of building by $200K, you suddenly get a lot more homes built.
Naturally. And what about the demand side?
Slower population growth. The 2026 to 2028 immigration levels plan significantly cooled the rate at which new demand was entering the market. So supply is rapidly increasing and demand growth is slowing down.
Okay, I have to push back here. So what does this all mean? Because everything you just said sounds great on paper. Prices are down 20%, rents are dropping, thousands of new units are being built. But if you are a first-time buyer listening right now and you pull up your local real estate listings, it still feels completely out of reach. Is this an actual fix we are seeing, or is it just a tiny release of steam from a kettle that's still boiling over?
If we connect this to the bigger picture, it is releasing a substantial amount of steam. The Department of Finance uses an affordability metric that measures monthly mortgage payments relative to median wages.
Okay.
At the absolute peak of the crisis, that metric hit 87%. That meant 87% of a median income went strictly to servicing a mortgage.
That is insane.
It was unsustainable. But today, that metric has improved down to 60%.
I mean, 60% is still incredibly painful, though.
It is. And the reason it still feels so painful is the core of this entire discussion. The actual barrier for you buying a home right now isn't just the sticker price of the physical house. It is the cost of the money you have to borrow to buy it.
Which brings us to the mechanics of mortgages. And this is arguably the most crucial part of these documents for anyone looking to buy or, anyone staring down a mortgage renewal. Because the entity controlling the interest rate on your fixed mortgage isn't even located in Canada.
Right. To understand this, we have to clearly separate variable rate mortgages from fixed rate mortgages.
Okay, let's start with variable.
If you hold a variable rate mortgage, your rate is determined domestically. It is directly tied to the Bank of Canada's overnight rate. And there's good news on that front. The Bank of Canada has recognized that the economy is cooling and inflation is largely tamed, barring that recent gas spike we talked about.
Right.
So they have aggressively cut their policy rate by 275 basis points, bringing it down to 2.25%.
So if you have a variable rate, you've definitely seen some relief. But fixed rates, which, correct me if I'm wrong, the vast majority of Canadians prefer because they offer a guaranteed monthly payment, those are a completely different animal.
Completely different. Fixed mortgage rates are not tied to the Bank of Canada at all. They are tied directly to the bond market, specifically the 5-year Canadian government bond yield.
Okay, I want to make sure I grasp the mechanics here because bond yields is one of those phrases that usually makes people's eyes just glaze over.
Understandably so.
Let me try this. If I'm a bank, I have a massive vault of money I want to lend out to make a profit. I essentially have two choices. I can buy a 5-year government bond, which is essentially risk-free and requires zero paperwork or staff to manage. Or I can lend that money to you to buy a house.
Exactly. That is the fundamental choice the bank is making. But lending money to you for a mortgage carries risk.
Yeah.
I mean, you might lose your job in default. It also requires underwriting, lawyers, and staff to actually manage the account. Because a mortgage is much higher maintenance than a government bond, the bank needs to be compensated for that extra hassle.
Makes sense.
So they charge what's called a spread. This is usually a premium of 100 to 200 basis points, meaning 1% to 2% above whatever the current 5-year bond yield is paying them.
So if I want to know what my fixed mortgage rate is going to be next month, I really need to know what the bond yield is doing today. But how does a bond yield actually work? I always hear that bond prices and yields are inverse, but it's confusing.
Let's avoid the textbook definitions and just look at how it works in practice.
Please.
Imagine you buy a government IOU for $100, and the government promises to pay you $5 a year in interest. Your yield, or your return, is 5%.
Okay, makes total sense.
Now imagine the global market panics, and suddenly nobody wants to buy those IOUs. Because demand drops, the price of that IOU on the open market drops from $100 down to, say, $90.
Right.
But the government still legally owes whoever holds it that $5 a year.
Ah, so now I'm getting $5 a year on a $90 investment instead of a $100 investment. So my percentage return just went up. The yield went up.
Precisely. When the price of the bond drops, the yield goes up. And when the yield goes up, your fixed mortgage rate goes up.
Okay, I've got it.
But here is the crucial revelation from the Pegasus and True North mortgage analyses. You might assume that the 5-year Canadian bond yield is controlled by the Canadian government or the Bank of Canada.
It isn't.
It isn't. It is heavily, inextricably driven by the United States 10-year Treasury bond yield.
Oh, wow. Here's where it gets really interesting. So the U.S. 10-year bond is essentially the gravitational pull of Jupiter in the solar system of global finance. Even though Canada has its own economy, and we dropped our housing prices by 20%, and we have our own central bank, if Jupiter moves, our mortgage rates get pulled right along with it.
Jupiter's a fun way to visualize it, yeah. But in reality, it's less about planetary gravity and more about a ruthless global auction house. Capital is fluid. It moves across borders with a keystroke. The U.S. 10-year Treasury is the ultimate global benchmark for safety and return. Imagine a giant room filled with global investors holding billions of dollars. If the U.S. government starts offering a higher yield, maybe because U.S. inflation is running hot, or the Federal Reserve is keeping rates high, all those billions of dollars rush to the U.S. side of the room to get that better return.
And to stop all the money from leaving Canada, the Canadian bond market has to offer a higher yield just to compete.
Exactly. Global investors will just sell off their Canadian bonds to go buy American ones.
Yeah.
That massive sell-off drops the price of Canadian bonds. And as we just discussed with the IOU example, when the price of the bond drops, the yield automatically goes up.
Which means the Canadian bank's baseline cost of borrowing just went up. And to maintain their 1% to 2% profit spread, they immediately raised the fixed mortgage rate they offer to me.
Yes, the mechanics are brutal, and they're instantaneous. This is why a surprisingly great jobs report in Texas or a sudden inflation spike in New York can directly result in you paying hundreds of dollars more a month for a duplex in Calgary or a condo in Halifax.
That is mind-blowing. But it also sounds like a strategic hack for anyone trying to time the housing market right now.
It absolutely is. Bond yields react to global economic news in milliseconds. But advertised mortgage rates at your local bank take weeks to adjust to those bond movements.
So there's a lag.
Exactly. If you see the U.S. 10-year yield trending upward consistently over several days, Canadian fixed rates will almost certainly follow suit shortly after. That is your undeniable signal to call your mortgage broker and lock in a rate hold immediately.
Wow.
Conversely, if U.S. yields are trending down, it might pay to be patient and wait for the banks to actually lower their rates.
It is incredible when you trace the dominoes all the way back to their source. Let's pull this deep dive full circle. We started out trying to decode the invisible strings connecting global events to your wallet, and the mechanisms are just undeniable.
They really are.
A geopolitical conflict in the Middle East chokes shipping in the Strait of Hormuz. That bottleneck drives up the global price of oil. Because Canada is a net exporter, our national macro numbers look fantastic on paper, but you get crushed paying $1.81 at the gas pump.
Right.
That forces the government to step in with a temporary tax cut just so you can afford your daily commute.
And simultaneously, you have massive domestic efforts finally making a real dent in housing. We are actively building 260,000 units. We've forced zoning changes with a $1.7 billion injection, and we successfully dropped average home prices by 20% and rents by 9%.
Right.
But the actual cost to finance that cheaper home is entirely tethered to the bond market. So despite all of our domestic progress and resilience, your fixed mortgage payment is still at the mercy of a global auction house reacting to American inflation data and U.S. bond investors.
It is a perfect storm of global headwinds and domestic resilience. It really is resilience meets reality. And leaves me with one final provocative thought for you to chew on as we wrap up.
Let's hear it.
As the global economy continues to fracture into these competing trade blocs, and as U.S. economic policies become more volatile and unpredictable, will Canada's unique position, being a resource-rich, low-debt haven, wearing this economic Kevlar vest, eventually allow it to break free from the gravitational pull of the U.S. bond market? Could the Canadian dollar and Canadian interest rates one day become the ultimate safe haven for global capital, fundamentally severing that invisible string and completely changing the cost of living for everyone listening?
It's the ultimate question for the next decade of Canadian economics.
Something to think about the next time you look at a globe
Cool.
or your bank statement.